Hello, everybody. Okay, I got my water. Okay, welcome everybody. It is Monday, October the 7th. Can't believe we're right into October already. So welcome to another session of Money Matters. And I am sitting here debating about whether or not I should talk to you. Or I was debating. I made a decision because I had to post the title of this. I was debating about whether or not I should calculate through a stock program that was offered to me a couple of weeks ago where I had to put in like X amount of money. But if I didn't take action within, 3 hours or that by the end of the day, it would basically double in price. And I'm like, you know what? Let me just take a step back. So I was going to go through that calculation, but something happened this weekend that really boiled like I was just so I want to say pissed off by the end of the call. And so I'm going to run through the situation with you because as fellow investors, I want to make sure that you have the information and the support that you need to make the right decisions. That's one of the reasons why I do these calls. Okay. Like these sessions are free, it's out there. If you don't agree with what I say, please let me know why you don't agree with me. I'd love to hear. Okay. And so while I'm live on here, you can chat with me on Facebook. You could put a comment on the YouTube channel when this goes on YouTube somehow. Okay. So and one of the reasons why I do this is because I have 25 years in real estate experience. Like I've been through the '08 crisis. I've been through the early 90s when the interest rates were like 15%, even though my first mortgage, I think, was like 9 or 10%. So I've been through all of those different cycles and I invest all across Canada. And so, except for Quebec. And so I've seen the markets change. I might not remember all of it. Okay. But I've been through it. And so I have so much experience and so much knowledge that I bring to the table. And that's one of the reasons why I do these calls is because I want you to have the wherewithal of when something is crap. Okay. And I just realized that I spelt avoid improperly on the title. So I'll have to change that. Okay. So I'm going to go through the situation that came up over the weekend that really was just like, oh my God, like, do not get taken advantage of like this. Do not go into deals. Do not go into opportunities with people, one, you don't know enough, and two, that you don't understand the opportunity. Okay. So we're going to go through that. Now, of course, I do have to say a disclaimer, please. Even though I have a ton of experience here, please go check with your lawyer, accountant, talk to another investor, somebody else that you trust implicitly. Okay, before you go and implement any of the stuff that I'm doing. Now, after watching this, you might be like, oh crap, Hong, I need to get out of whatever partnership I'm in, or I've got this opportunity I'm looking at and I don't know how valid it is or if it's worth pursuing. Okay, well, reach out to me. I am definitely available to do those conversations. It doesn't cost a thing. Seriously, like I will hop onto a Zoom call or a phone call with anybody to talk about real estate, as long as it's about real estate. Okay. And it doesn't cost you anything. Okay. So let's jump into this. Okay. So this is a deal that came up. It's not a deal that I'm working on. And once I got the information, I'm like, there's no way I would ever touch this deal. Okay. It is not an opportunity that I would recommend for a fellow investor. Now, if you are looking for a place to invest in, to park your money, and maybe, sit on the appreciation and potentially go there and have a lifestyle there, that is a different purchase. Okay. But they were coming to me saying, hey, Hong, would you like to come in on this opportunity as a passive investor, making 17 to 23% roughly, plus a potential appreciation of 6 to 8%. So you're looking at maybe, 26+% return on a pre-built condo purchase right now, and then a bachelor condo in ownership with another person. Okay, so let's run through the numbers here, and hopefully by the end of this, you'll see why I think this is a crap deal, something that I basically said, hey, you know what, this is a crap deal. Avoid this opportunity. Do not do, like, as an investor, this is not an opportunity. Okay. It is basically put your money in and never see it back. Okay, so here's the opportunity here. So, oh, I need to share my screen. Okay, good thing I caught myself on that one. So let me see, where is my share button here? All right, so here we go. All right, so let me bring up an Excel sheet. We'll walk through the calculations here together. Okay, it's not much of a calculation because just the premise of the partnership didn't even make sense, right? So let's run through this. Okay, so the purchase price is about 230,000, and this is Canadian. Oh, 23,000. Yeah, if it was 23,000, I would definitely buy it. Still no. Okay, so 230,000, and this is in Canadian dollars. Okay, I'm in Canada, so I operate in Canadian. Okay, so some of the numbers may be a little bit off here because the opportunity was presented in US dollars. And so I'm gonna use Canadian where I can, and if I need to, I'll do a bit of a conversion. Okay, so 230 for the purchase of a bachelor condo. Okay, so a bachelor condo is like maybe 580 to 650 square feet on the high end. Okay, so it's not a big space. Okay, and then with this, because it's a condo, there's maintenance fees. Okay, so maintenance fees. Okay, and because this is one of those rental programs, so you would be buying this, putting your condo into a rental pool, and then there would be a team there that would rent out your unit. Okay, so there's a maintenance fee, and I think it was like, $200. Okay, so how is that for maintenance fees? Okay, well, you can calculate that based on square footage. So let's just say it's 580 square feet. Okay, so then square footage is dollar per square foot. So $200 divided by your square footage. Okay, so that is per month. So you're paying 34 cents per square footage per month. Okay, sorry, I just got an automatic floor cleaner and I can hear it going berserk somewhere downstairs. So hopefully it just shuts off and hopefully you didn't hear any of that stuff. Okay, so that's square footage. So this isn't too bad. Like I've got my one condo in Toronto, it's 650 square feet. We're paying about $450 a month in maintenance fees, right? So as you can see, it's already a little bit higher. So per square footage, it's dollar per square feet. So I'm taking the dollar amount divided by my square footage. So I'm looking at 69 cents. So my Toronto condos almost double what they're charging for maintenance fees. Okay, so now the other thing to consider is that they charge the property management fee for the rental program. So I'm just going to put the rental program here, and they're charging $500 a month. They couldn't tell me if this price, the $500, if it was set, regardless of how much my unit is rented out in their rental program, is it $500 flat? If they rent out more of my unit and make more money, does that program fee go up? They couldn't tell me. Okay, so there was a lot of questions that couldn't be answered on the call, and this was one of the questions. Okay, then let's see, what else did we go into? So then the individual that was presenting the opportunity to me, they were literally putting in maybe $10,000 to $15,000, maybe not. Okay, so let's run this scenario where I'm putting in the majority of the money. And so they presented me with two options. Okay, so I'm going to put option 1 here, and I'm going to put option 2 here. Okay, because it's good to know these options. So I'm going to run this scenario without this one partner putting in the 10 to 15, because he actually said, I would prefer not to put any money in. Okay, so the first option is that I've got 230 in cash, and I put down the whole entire 230,000. So that's 230. Okay, all not call, it's all cash in. Okay. With that, I would still get not 100% ownership. Okay. I would still only get 65% to 80%. Okay. And the reason for that is because this other person would be my general partner. They would be the active partner in helping me manage this one bachelor unit. Okay. So this is my take. Okay. And this other person would get anywhere from 20 to 35. Okay. So this is another thing where it's like, well, wait a minute here. I have 2 weeks to make a decision. Okay. Because that's when they wanted me to make a decision in 2 weeks. And you can't tell me if your involvement in this is going to be 20 to 35%. Like everything was still very up in the air. Okay. And it could be that because it's like they're open to negotiations, right? But here's the thing though. Why do I need to pay a partner 20 to 35% of the cash flow, of the mortgage pay down, of the appreciation, when there's a rental program company already doing the work? Okay, so I'm just like, what? Like, why would I be paying you and paying them? Right? So the other thing I want to point out here, based on a $230,000 price point of getting in, and if they charge a rental program of $500, okay, I'm just going to do another quick calculation here. So you take $500 divided by your 230. Is it that way? No, the other way around. So 230 divided by your $500. Nope. Let me think. Oh, no, sorry. So it's not based on that. They were estimating that the cash flow coming in would be $2,000 something dollars. Okay, so let's just say it's the NOI, okay, because it's the net operating income for the program before any debt servicing was, let's just say 2,500 here per month. And then every single month, I'm going to be giving them 500. Okay. So this means that this fee is 500 divided by 2,500. Is that right? Yeah. Okay. So roughly it's about 20%. Okay, on that management fee. Now, if you're calculating it based on the gross income, okay, and I think the gross income was like 3,200, let's just say. Let's see here. So let me put the dollar sign in front. Okay, so the total then is, let me see. Oop. Then the D. Okay, so I'm going to go this 500 divided by my gross income. That's 15%. Okay, so based on the gross income before any expenses being paid out, they would take about 15%. If I take into the account what my expenses are going to be, because there's management fees, there's utilities, all that stuff going in, some legals, whatever, then I'm making about, sorry, this rental program is going to cost me 20%. So let's just say it's 15% that I have to pay them from the gross income. Okay. So I'm already paying a property management company 15% to basically help me rent out my unit because I'm not there to rent it out. And it's in a pool, right, of rental units. So they're already taking 15%. And then on top of that, I'm paying my GP, like my active working partner who is bringing me this opportunity, 20 to 35%. Okay. And so I said, well, if I manage it myself, if I just do the rental program myself, do I have to pay this $500? And he goes, I don't know. I have to get back to you. Okay. Usually in those rental programs, you don't have a choice. You have to be a part of that rental program. Okay. And then it was like, okay, well, hold on a sec. If I'm already paying this rental program 15.6%, and then on top of that, I'm paying you as my active partner to manage the manager, 20%, that's 35% of my profit going to somebody else. That's a lot. Okay. Okay. So then so that's for option one, where I bring in all my cash. Okay. I'm buying a bachelor unit for 230 Canadian. Now you can say, well, 230, that doesn't get you a lot in Canada. It does. You can actually buy a condo still for 230 in Alberta. You can buy a condo for 230, full price. Okay. Full price, 230 in Canada, in Alberta, which is more landlord friendly than other provinces. You can buy probably 2 houses in Saskatchewan, okay, or even in Manitoba. Okay. So there are places that you can buy decent properties for 230,000. You don't need to go elsewhere. Okay. So just something there to think about. Okay. The second option, okay, like this opportunity really made me so pissed off, because I cannot believe that somebody actually thought this was a great opportunity. Like, and they were presenting it like, oh my God, this is the next best thing to sliced bread. And if you know other people who are interested, please let me, introduce me to them. I'm like, no, there's no way I'm doing that. Because one, I'm not putting my friends and family and connections into harm's way with an opportunity like this. This is not an opportunity that I would support. Okay. Second option here was to come in with half the money. So 115,000 of cash. Okay. Now, what their proposal was that I would borrow this from my HELOC. Hey, Canadian investors, if you've got HELOC money, you can do an investment. Okay, so that's what they were proposing here. 115 from my HELOC money. Okay, HELOC money is not free money. HELOC money is borrowed money using one of my rental properties as collateral for that money. Okay, so I am actually paying prime, whatever prime might be, plus a percentage in interest here. Okay. For some people, it's, 6%. Some people is 7, some people is 8. So really I'm paying maybe 7 to 8% here in interest on this 115. Okay. Every single year. Okay. So you look at that. And so let's just calculate it at 7% here. Okay. Whoop. Okay. So I'm going to go 7%. Okay. So what that works out to be, if you want to just calculate interest only, okay, because on HELOC money, you just have to pay the interest every single month. Okay. So the 115 times $7,000. Okay. Sorry, times 7%. That's $8,000 for the year. Okay. So let's divide that by 12. Okay. So that's $670,000 a month that you have to pay. So think of it this way. If my NOI is already 2,500, so this is after all the rental income coming in minus all my expenses, now minus my cost of borrowing here. Okay. My profit now, my cash flow is 2,500. Okay. Now we're actually getting into the calculation. So which I didn't think we were going to get into, but this is actually really good. Okay. So which means at the end of the month, I would actually make about 1,800. Okay, well, you know what? That's not a bad idea here. Okay, but it goes more. Okay, let me explain the rest of this. So now I've put in 115,000. The company that is going to build this condo, the entire building complex, I'm going to just be purchasing one condo in the whole thing. They're going to fund me the rest of the money that I need. So that's basically half of it. Okay. So what they're telling me is, Hong, put down 50%. So this basically works out to be a 50% down payment. Okay. And we will fund you the rest of the mortgage. Okay. Fantastic. So now this is going to be a mortgage. Okay. Funded by the builder. Okay, who's also the management company and who's also the developer and the builder. Okay, they're going to fund this. Now, what they're going to do is they're going to charge me 10% for a mortgage. Okay. So here's the thing. This 115,000 doesn't come from the builder. The builder is going to go and get a mortgage from a bank. Okay. They're going to get whatever local institution to give them a big mortgage to build. So basically, I'm funding their build costs. I'm funding their down payment, the cost to get shovel ready, to dig, to build up. Okay, so I'm paying for that with my down payment of 115. Okay, so all of that is all pretty normal in a development deal. Okay, so now this company is going to put on a mortgage and I'm going to have to pay them 10% on this money. Okay, so now this 10% on the 115 is not interest only, because what they're going to do is they're going to amortize it over 25 years. Okay, and when I asked them, hey, is it 25-year term as well? So it's going to be locked in at 10% for 25 years. They didn't know. They couldn't tell me the answer. Okay. So let's run it based on the assumption that it's a 25-year amortization, because we just don't have the information. So let's go into a payment calculation. So the rate is 10%. Divide that by 12, because that's just the way you have to put in the formula. Okay. It's a 25-year times 12. So that's going to give me, I think, 350 or 360 or something like that. And then my present value is going to be the 115. My future value is going to be 0. And my type is going to be 0 because it's going to pay at the end of each month. Okay. So my monthly payment, my mortgage monthly payment on this loan is going to be $1,045. Okay, so this is going to be monthly. So I'm going to move that over here and I'm going to put a negative sign in front. Okay, because that's how much money I have to pay every single month for that. So now I'm going to go back up here and calculate what my actual cash flow is. Okay, so this is my cash flow at the end of the month. Okay, so let's go that over here. So this the 1,800 now is going to minus my monthly payment on the interest. So I'm going to make $784 a month. Okay, so if this is possible, if they're able to rent it out at the prices that they say, excuse me, if they're able to rent it out at the price that they say for the amounts here, and the fees are going to be this, there was a bunch of other fees as well, and you make $780 Canadian, that's really good. Okay. However, okay, the reason why I didn't like this opportunity was because the rental income, there was no guarantees on it. They were not providing a rental guarantee program at all. Okay. And let's see here. Okay. So for me, there was enough on this opportunity to like, it just did not make sense as an investor to go in on an opportunity like this. Okay. The other thing was when I asked them to explain to me how they got the 17 or the 16% to 23 to 24%. Okay. Plus the potential of 7 to 8% appreciation. Show me how those numbers are calculated. They couldn't show me. Okay. So for me, that is a big no-no. Like if your general partner is coming to you, asking you for money, and they can't explain how the ROI is calculated, they can't give you the historical data to show the appreciation that has happened. If they can't break down how the 16% is calculated, is it all from cash flow? Is it all from mortgage pay down, right? How are they getting that number? Because here's the thing. If you go with option 1 versus option 2, your mortgage pay down is going to be completely different. In option 1, there is no mortgage pay down because there's no mortgage. Okay. So then that is going to affect that mortgage pay down portion within your ROI calculation. Okay. And then to take out a loan, to have a mortgage at 10%, that's private lending money. It is not like the mortgages that we're used to here is like, 4, 5, 6, 7% on the high end, maybe 8. If you're into private lending, you're looking at maybe 9, 10%, 12 to 18% on seconds. So this 10% is like private money. Okay. So, so you sort of have to weigh that out. So now you're borrowing money at 17 to 18% here. Basically, by the end of the day, like you're at 7% on a portion and 10% at another portion. So you're roughly around, 8 to 9% by the time it's all said and done. Okay. So this is a deal where if your partner can't explain a lot of the details, okay, and if they're not willing to give you the information so that you can take it off and run your own numbers on it and go to your trusted advisors and say, hey, does this project make sense? Does it make sense for me to put in 230,000? Does it make sense for me to even split it and go 115, maybe borrowed money? Okay. So yeah. So if they're not willing to give you that information, stay away from opportunities like this. Okay. So sorry, I like the opportunities like this to me is not an opportunity. This is put your money in and never expect to see anything and hope for the best, right? Which is not what we want to be doing with our money. Okay. So I am going to cross that out. We cover that. Okay. So next week, hopefully then we will not have a situation like this. And I will be doing something like, hey, does it make sense to, go to Costco and get discounts on your food and buy in bulk? Okay. Which was what I was going to do today, but we will leave that for next month. All right. So a shout out to, we are closing in on our book collaboration. So we are going to be launching that this week. So if you want to participate and if you want to help me and the fellow authors that are in this book collaboration, please, I have a special, super awesome deal for you. We are going to be putting it out, pre-launching it, and I'm trying to get it for like super, super cheap. So you're basically spending like $1 or $2 on this book during the pre-launch. After the pre-launch, it's going to go to full price. Okay. Now we are doing right now for another day, we are doing the pre-launch, which is if you put in the comment book, I will send you an ebook version of it at no cost. So it's not even going to cost you the $1 or $2 for the pre-launch offering. But if you happen to miss this and the pre-launch now goes into effect tomorrow, then it's just going to cost you $1 or $2, and which I will then pay you back when I see you in person. Or if you're buying this to support one of the other authors, they will pay you back when they see you in person. Okay, that is it for me. I've got a bit of a cough, and so I'm going to go and have some tea and enjoy the rest of my day. And yes, if you would like some assistance on analyzing opportunities like this, please reach out to me. I will put my email in the comment box, and please reach out to me at any time. Okay, thank you everybody for watching. Have a great week. Bye everybody.